Welcome everyone. We're just going to give about 30 seconds to a minute for all of you guys to filter in, but welcome, you're in the right place. Thanks for joining us, everyone. We're just giving about 30 seconds to a minute for everyone to filter in, and then we'll get started. All right. Let's go ahead and get started, everyone. Hello, welcome to our first webinar in the Back to Basics series, GASB 101 Compensated Absences. We're so happy to have you here with us today. Now, before I introduce our presenter, a few housekeeping items. This webinar is being recorded, so be on the lookout later today for an email containing a link to the recording as well as a copy of the slides and other resources. This webinar will run 50 minutes with a 10-minute Q&A immediately following. If you have any questions for our speaker, please put them in the Q&A box located in the Zoom toolbar. To find that, hover your mouse over the top or bottom of your screen and a toolbar will pop up. This webinar is eligible for 1 hour of CPE credit. We will launch 4 polls throughout the presentation. So to receive credit, you must answer 3 out of the 4 polling questions. You must also complete the short evaluation that you will receive afterwards. LSL is using a new CPE system, so please note that the evaluation email will be coming from LC Vista. Please allow up to 1 week to receive this email. If you're having trouble seeing the polls, try minimizing the Zoom screen, as sometimes the poll box might pop up behind that. All right, now I'd like to introduce our presenter. James Butera is a director in LSL's Assurance and Advisory Department, specializing in government audits and public sector consulting. With experience as both a finance director in local government and a director in public accounting, James offers a unique dual perspective that strengthens both his team's audit execution and his clients' internal operations. His firsthand knowledge of the challenges facing finance departments, from year-end close to compliance with evolving GASB standards, allows him to provide practical, tailored guidance. Whether he's leading an engagement team or advising on complex reporting issues, James is committed to advancing the financial health and accountability of public agencies he serves. Okay, James, take it away.
Right. Thanks, Cami, for that nice introduction. I'm excited to kind of kick off our new season of the Back to Basics webinar series with a topic that I think most of us right now are in the thick of. So as Cami mentioned, my name's James Butera. I'm a director here at LSL. I've been here with the firm now a little over 3 years. Time is flying. And before coming on board here, had about 8 years experience between both the public accounting realm, serving governments, primarily in their assurance department, as well as a finance director for a mid-sized municipality here in New York State. So I am one of our remote directors. I'm in the Buffalo, New York area. But I'm lucky enough to have the opportunity to fly out to California, kind of escape some of the New York winters here, often enough that sometimes I don't even consider myself remote anymore. So I live out here with my wife and our 2.5-year-old twins. They keep us very busy. They keep our hands full. So I think any parent on the call here can probably attest, 2.5, we're working on sharing toys and all that fun stuff. But the one thing that we seem to share really well are germs. So bear with me as I'm kind of getting over a cold here, thanks to them. But on that note, figure we'll get rolling here. And like I mentioned, I think it's a good topic to start off the Back to Basics series with. We're all kind of at varying stages of implementing GASB 101. Obviously, most of the agencies we work with are June 30 year ends. So fiscal year 25 is really kind of that starting point for a lot of the clients we work with. So just wanted to kind of kick off with a quick polling question here, kind of looking at what stage of GASB 101 implementation are you currently in? And haven't started, evaluation and information gathering, or completed. And I would just say, from our perspective, we've seen a pretty wide range so far. We had a handful that actually early implemented in fiscal year 24. As we're going through our interim process right now, I know a lot of our clients are on the call, and some of your interims are actually going this week. Some we've actually had pretty in-depth meetings with and kind of evaluating policies and the implementation approaches. Some, haven't really gotten to implementation yet, but are kind of saving it for year end. So just kind of good to kind of gauge, um, the varying stages of everybody on the call here. So just a quick overview, GASB 101. The implementation is effective for fiscal years beginning after December 15th, 2023, and all reporting periods thereafter. So, as I mentioned, the vast majority of clients we work with are going to be June 30. So, 99% of our client base is going to be implementing this year. And I think, from the objective of this statement right here is straight from the standard. It's better to better meet the information needs of financial statement users by updating the recognition and measurement guidance for compensated absences. I think when we kind of think of sometimes all the GASBs that have come out recently and are set to come out, sometimes it seems almost that they're releasing standards just to kind of keep us busy or give us work. But I think here, if you break it down, the concept and purpose is really just to kind of get an apples to apples comparison here and get a unified approach when it comes to evaluating different types of leave and compensated absences. When you're comparing, Act for A to Act for B, as leaves become more robust and employment benefit options are more diverse. I think a more unified approach did make a lot of sense, and I think overall it's a good implementation. So looking at a little bit of a comparison here, and kind of looking at the why of why GASB 101 is coming out. So GASB 101 is going to supersede GASB 16, which you can see came out in 1992. So like I was barely born here. So I think overall it was just kind of time to take a look at what pieces of GASB 16 were working, what types of pieces maybe were now outdated, and kind of look to really build upon and enhance some of those requirements from 16. So the general consensus is kind of GASB 16 was really rules based. It evaluated three leaves in particular: vacation, sick, and sabbatical. And it was only accrued if probable to be compensated upon termination or retirement. So when I was the director of finance out here, the sick time that was accrued by employees was not paid out upon either voluntary or involuntary termination. So sick time really wasn't part of our compensated absence balance. But if you looked at an ACFR from the city right next to us, and perhaps they did pay out sick time, that liability amount could be very different, even though we're similar in size and have a similar employee count. I think with GASB 101, it's really kind of looking at, just because we didn't necessarily pay out sick time upon termination of the employees, there was likely still a liability there that we potentially should have been capturing that wasn't actually recognized or measured on the ACFR. So GASB 101 is going to evaluate all leave types, regardless of payment likelihood upon termination or retirement. And the three kind of buckets or pillars that GASB 101 is evaluating are cash payments when leave is used for time off. So pretty standard, PTO usage, sick time, vacation, etc. Other cash payments, such as payments for unused leave upon termination of employment, and then non-cash settlements, such as conversion to defined benefit post-employment plans or benefits. That third pillar is a little has has had some questions and is a little bit vague because the most common sort of scenario that we see is a lot of unused sick time, potentially could be transferred as like CalPERS credit or retirement service time used. And that type of conversion is actually excluded, as we'll touch on later. So overall, I think for the most part, the most common scenarios for that third pillar that we've seen is most likely not applying to a lot of the agencies we work with. I think for all intents and purposes of this webinar, we're kind of going through evaluating some of these circumstances with really kind of thinking of those first two buckets. So either a cash payment for actual leave, um, using for time off, or that other cash payment for termination. So that's kind of the two buckets that we'll kind of focus on here. And then anytime any new GASB comes out, either it's deemed from an implementation impact perspective by the GASB. So either a low, moderate, or high impact. And GASB 101 has been determined to be a moderate impact and kind of compared to, GASB 87 and 96, which was deemed as high. I think we can likely all attest that, that high designation was accurate for that. I think overall, GASB 101 is really going to be on a case-by-case basis, and it's really contingent on specific policies and procedures of each agency. So moderate does seem right. Some really may have little to no impact on a city or agency, and a couple of the early implementers that we worked with last year really had a minimal impact. No sort of adjustment was needed outside of just disclosing that they implemented GASB 101. But I think a lot of the big change is going to be for that second bucket that we sort of touched on a minute or so ago, where it's paid upon termination. And the city that I worked at will have to sort of reevaluate some of that leave. And I think a lot of the clients that we work with are going to kind of fall into that bucket. So that so far that we've seen has been kind of impacting the big significant implementations. So overall, to determine kind of step one here when you're evaluating your compensated absences is to evaluate each of these three criteria. So all three have to be met in order for your city or agency to have a compensated absence that will need to be measured. And criteria one is not changed at all from GASB 16. That is it has to be for services that are already rendered. So an employee works the time and obtains the hour accrual in their bank. It could be whether they work that month, and it could be a monthly accrual or that pay period. It could be like a front loaded where they work the first month and then they get an annual sick time loaded into their bank. Anything that does not warrant any further service needed from that employee is kind of step one. So if you check that box, then you move to the second criteria, which will be it needs to accumulate across fiscal years. Here could be that we've seen could be some slight nuances. I don't think use it or lose it policies are maybe as prevalent as they may have been. But if there is an instance where maybe you're front loaded to start the year, sick time is usually the most common, where if it's not used at the end of the year, your bank just clears out and maybe it reloads again. If you're kind of gauging that on a fiscal year basis, then this step two would exclude you from any evaluation there. Some could measure it on a calendar year in terms of use it or lose it, but for the example, we could say a June 30 year end. In that case, if it's like a front loaded January 1st type of a bank, and then December 31st, anything unused is kind of lost. You would have that accumulation from June 30 to December 31st, and then it would it would fall under this determination of kind of estimating what would be used between that July to December timeframe. So if you check the second box, then we move to the third criteria, which is also going to be a little bit different than GASB 16, and that is more likely than not to be used for time off or paid out upon termination. So those are those kind of two main buckets that we'll keep referring to. And for GASB 101, it is explicitly defined as greater than 50% compared to GASB 16, which was probable. And there was no specific determination of what probable was for GASB 16. So that kind of led to a lot of agencies kind of having a varying approach. Some could say 70, 75%. Some could have used a 50% threshold. So it was just open to more interpretation, and that interpretation could, significantly dictate the amount of liability recorded. So, as of the implementation date, anything greater than 50%, considered to be used would fall and would fall under this. So those are the three requirements for recognition. And another big change is the concept of vesting. So throughout GASB 16, vesting is referenced very often, and it kind of goes back to that main sort of idea that if it's not paid at termination, historically there may have not been a liability recorded, or maybe an employee had to work 5 years or 10 years in order to get a particular benefit paid out upon termination. There would be no leave recognized until that vesting period was hit. That is no longer a requirement under GASB 101. It may not fall under that first bucket, but it would be kicked to that second bucket. And the idea of vesting was kind of the GASB went back and forth on it. They did determine essentially that at least a current liability would be present if there is a vesting requirement for an agency. They considered maintaining the requirement in GASB 101, but I think a lot of feedback from different stakeholders involved and different exposure drafts kind of determined that most governments should have access to information to really determine an estimated usage. So they decided to, take that recognition requirement out. And then in terms of calculating that liability, no real change from GASB 16. There are some minor tweaks or potential exceptions that we'll touch on, but it's estimated as of the rate of pay as of the balance sheet date, and includes any salary related payments, which are most commonly employer share of Social Security or Medicare taxes. So just hopping into a quick second polling question. And I know it's a pretty large attendee list here, so could be good to kind of also gauge your agency's policies, maybe compared to the similar ones. But does your agency currently pay out benefits to employees upon termination? Yes, no, or kind of a combination depending on type, which is kind of the one that my city fell under. And depending on your answer here, could very well kind of determine the impact of implementation on your city or agency. So looking at evaluating the leave. So at this point, we've kind of went through and determined, okay, we've checked the three requirements. It is for services rendered, it accumulates across fiscal years, and is more likely than not to be used or paid out. Once you kind of determine, those three boxes are checked, now it's time to evaluate the leave. So here's where it's gonna, get into some really specifics and dictating depending on your agency's policy. And there's going to be likely areas of the policy that are going to be requiring some updates. So flow assumption between LIFO and FIFO that we'll touch on. And I think um, we do have a couple questions on that coming through, which we will touch on in a couple slides. And I'll do our best to kind of get through all the questions at the end as time allows. If not, we'll definitely touch base after the fact. But the LIFO or FIFO approach in terms of the flow assumptions, it's going to be almost guaranteed to have to be updated in your policy. Um, Formally outlining what type of leave is to be paid out upon termination and what isn't. Sometimes a lot of these policies are almost inherently known at agencies, but potentially not explicitly stated. It really should, for clarification purposes, be in the policy. Um, and then a couple questions did come through on the days used versus dollars paid. That is the GFOA does have a tool out there in terms of evaluating the sick time. There's no potential right or wrong way to go about that. It's all going to be kind of specific to your agency, number of employees. But I think from our perspective, the historical information is really um, you know at the employee level is really what the GASB is looking for. Obviously, depending on the size, that's not always feasible. It could be kind of summarized and estimated by department, sampling employees from a department depending on size of that department. Really, just has to come down to be reasonable. When I was a finance director, we did have a very large spreadsheet broken down by employee that did track it at that level, broken up by department still. So, I mean, we could have estimated by department for probably a little bit more efficient, but really using the historical information is um, probably the best route to go. So anything about the use, payment, or forfeiture of compensated absences, depending on the policy. So any sort of, like I knew particular employees at our city that used every hour of sick that they got every year. Some would use just enough to carry over the max every year. So there was a lot of information out there based on their use to kind of estimate, okay, what are we looking at for them to use next year or the year after that. The one key point though is, just to be aware of information that would indicate that, that historical data may not be indicative of the future trends or patterns. I think, with looking at a look back period, like we touched on, I think during the GAT update in April, COVID was a big spike or decrease in usage depending on whether it was sick or vacation time. So, using a look back period that includes 2021 or even maybe 22 might not necessarily be indicative of, what's to be used in the future. I think overall the GASB is most likely looking, most robust at like a 10-year look back period, kind of like a statistical section or the RSIs that have a 10-year analysis period. I think to kind of start off with implementation, our recommendation is at least 2 years is probably more indicative, just 23 and 24, kind of just foregoing 2020 through 2022 to be on the safe side. I think overall, from an audit perspective, a lot of the impacts of COVID, by the time we got to like the 2023 trial balances, were for the most part kind of getting back to normal activity. So that's kind of the recommendation that we have there. Um, so then kind of just going hand in hand with the policies, for our third quick polling question here is, has your agency evaluated and updated your employment policy with the new GASB 101 requirements? Yes, no, or in progress. I think some of the cities we've kind of been talking to so far didn't necessarily think about updating their policy yet. Some did have the ball kind of rolling and in the process in motion. So just another kind of good gauge for your specific agency here compared to the others on the call here, to kind of see where you're at. So I know had a question come through on LIFO and FIFO, and what factors to consider when choosing which template to use. I think it's really going to be, um, you know, it's going to really depend on your policy. So from a LIFO and FIFO perspective, I would just say that the GASB was originally, their plan was to require FIFO. So I think the first in, first out is likely the most common that most cities are inherently using right now. I think LIFO overall will likely generate a smaller liability, but I think looking at just how you've been calculating it currently is kind of a good determination of how to do it moving forward. Trying to get us the smallest liability, I think is not necessarily gonna be the best documentation from an audit perspective, but um, it's also kind of a unique scenario to think of LIFO and FIFO from an employee benefit perspective. Obviously, we think about it when it comes to inventory valuation, but it will be impactful on the ending liability depending on which route is chosen. And then so I guess from a FIFO perspective, it's first in, first out, right? So it essentially takes it as the oldest hour accumulated in the bank is first hour to be used. So if you know you have an employee that doesn't ever use more than their sick time that they get a year, and say that employee has 200 hours in the bank, um, that 200 hours is going to be estimated at, okay, what portion of that liability will be paid out, and that 200-hour bank is really the basis to determine the liability, compared to if you're looking at it from a last in, first out perspective. It's operating under the assumption that the most recent hour earned, so on a month by month basis, let's say, those hours are the first ones to be used. So if that employee has the same 200-hour bank, and that historical data shows, this employee historically uses fewer hours a year than they get. So maybe they get, they accumulate 40 hours, or, over the course of a year, they get a week of sick time. Um, the argument could be made that that 200-hour bank is not, it's not going to be, it's not going to be used for time off. Or a very small percentage of it will be used for time off because that employee historically uses less than they earn. So potentially that first bucket that we touched on about to be paid off for time, for a regular time off, maybe it doesn't hit that bucket, but it would fall under that potentially paid upon termination bucket. So that 200-hour bank under the LIFO would still factor into the overall compensated absence calculation, but likely at a much smaller percentage, depending on the policy of how those benefits are paid out upon termination. Um, and then we'll touch on the dollars paid and days used approach too. Those are kind of the two pillars of the GFOA tool, and it really just kind of again comes down to what you think is most accurate for your agency. Whether it's looking at the dollars paid approach, where you could be sampling um, a sample of terminated employees and looking at what they were paid out or what they used, and try to kind of use that as a future estimator, or the days use approach, where maybe take a sample of current employees and or do it at an employee level and look at what have they historically used. I think a days use for the current employee pool is probably more indicative of what future usage will be, but there is no right or wrong way. So here's just some common exclusions. So parental leave, military leave, jury duty, unlimited leave, or holiday leave. So anything that is dependent on the occurrence of a sporadic event or affects a relatively small proportion of employees in any particular reporting period should not be recognized as a liability until that leave is utilized. Um, so I think parental leave is a big one that most likely will not fall under the compensated absence calculation. Jury duty, another common one, and unlimited leave, not as common in the government realm yet, but definitely not off the table to start becoming more common, as that is a little bit more common as the years go on in the private sector. But those would be excluded under GASB 101. All right, so kind of looking at determining the calculation. Um, it's not going to be super different as we mentioned from GASB 16. So the liability should be measured at the employee's rate of pay as of the date of the balance sheet. Unless there is a known, more likely than not, rate of pay that this will be paid out at in the future. So this would most likely fall under that bucket two, where it'd be paid upon termination benefits. Um, this would not include anticipated pay raises. So even if they're scheduled for a pay raise in the future, it would still be paid, or it would be calculated as of the pay rate as of the balance sheet date. But there could be, maybe there's a policy where upon termination is paid out at an average of 5-year rate, or maybe depending on level upon retirement, there's a set pay rate that those hours will be paid out at. In that instance, which is actually one of the examples we'll look at towards the end here, you would still kind of take that amount to be estimated to be used first, and then anything remaining in that second bucket of paid upon termination would be calculated at that anticipated pay rate. Um, that second option here, that leave is not attributable to a specific employee, could I think is we did have this at our city, where there was kind of like a pooled bank of sick time that employees could kind of use as needed. Sometimes employees donated hours, which is another kind of unique wrinkle to this calculation. But in that instance, if there's any sort of a pool of hours that a particular department or a particular group of employees are able to draw from, in that case, it would be the average pay rate of those employees eligible to get that leave to calculate uh, as of the date of the balance sheet. I'm just scrolling through some questions here. Like I said, we'll definitely try to touch on all of these at the end, and respond or type as needed. I know some of them requested to be responded via typing. Um, so overall, so salary related payments, again, not very different from GASB 16. So really obligations incurred by the government related to providing the leave in exchange for the services rendered. The most common is going to be the employee share of Social Security or Medicare taxes, but materiality does come into play here. So applying the percentages to an overall pool or overall balance, could be considered reasonable. May not be feasible to do that at an employee by employee level. Um, you know, it may be immaterial in general, depending on certain thresholds or certain opinion units that maybe it's attributed to. Um, so that's why I always say when I'm talking to our clients is just we're here to answer questions on the calculation or run things by us, because we can kind of help gauge that materiality level from an ACFR perspective, and maybe make your life a little bit easier when it comes to the calculation. The salary related payments are either directly or incrementally associated with leave. So either as a direct result of as payments fluctuate, these salary related payments change in accordance, or incrementally associated, meaning like it's in addition to the salary paid. And then I think the big one is any sort of contributions to like a CalPERS or an OPEB plan are not included in the measurement of the compensated absences. And then similar here, just to kind of touch on, because it is almost contradictory to that kind of third bucket from one of the first slides, is basically any type of CalPERS or OPEB liability. It's going to have potential leave conversions or sick time credits factored into the calculation. So including some of that time in the compensated absence liability would essentially double book that liability, because it's already in either the net pension liability or the net OPEB liability. So our last polling question here, do you anticipate any prior period adjustments or significant impacts on your statements for ACFR as a result of GASB 101? Yes, no, or whatever my auditor tells me. Could be option 3, but like I said, we've evaluated a lot so far, and I would say half maybe are looking to have a pretty significant adjustment, and the rest are either no impact or minimal impact. So really does kind of depend on the policies and specific characteristics of the city. So kind of on that note, from an audit preparation perspective, just to kind of um, start the wheels in motion of planning for that year-end audit early. These are likely the requirements that your auditor that we would request. Obviously, that employee benefit policy is sort of that source of truth and really going to be the basis of those implementation, depending on the flow assumptions or types of leave that are paid out. That'll be really step one in that kind of source of truth. So you kind of want to, kind of evaluate that policy and get some of those updates in place, over the summer. You know, have it approved through a resolution, and just kind of review GASB 101 to make sure that you guys are covered when it comes to kind of supporting that calculation. And obviously the estimation and calculation itself and kind of the support that goes into it. So, from our perspective, we're evaluating the estimate essentially, from, a reasonableness standpoint, utilizing materiality depending on the opinion unit. So just kind of being able to document and sort of support how, you got to certain estimates, which forfeiture rates you used, how many years back you went. Maybe sending the spreadsheet of the calculation is likely going to be a request. So whether it's on an employee by employee level, for large cities, maybe it's sampling the employees or averaging departments together. Really just kind of, ensuring it's reasonable based on, the specifics of your agency is really what we're, trying to get out of this and what we're recalculating. Any sort of change in pay rate adjustments. So maybe as of fiscal year 24, an individual got a promotion and a large pay raise. Any sort of significant pay rate adjustments to sort of support that. I would prepare to kind of have that information ready. And then, whether we prepare your ACFR or is prepared in-house, the impact is actually a slightly less robust footnote. I know it was challenging at times to kind of break out the gross additions and deletions in that footnote, but right now, for fiscal year 25, it'll just kind of show a net change. So I think, overall, that's actually less work for the disclosure, which is a welcome change. So running through just some examples of kind of how to implement, and as we kind of wrap up here. So we have a few examples here, which are actually pulled from uh, different state controller websites and examples. So these are kind of the scenarios that, in their eyes are the most common. So situation one is, if a policy provides unlimited PTO, that is one of the, explicit exclusions. So, leave would not be recognized as a liability in that case until used. So essentially in this scenario, there's really no employee bank per se that's accumulating over each fiscal year if it's an unlimited ability to use those hours. Doesn't necessarily fall under that criteria, and it really doesn't have a base point of estimating and calculating that rate. Second situation is paying out 100% of balances. So total accrued leave balance would be calculating using the pay rate at year end, including any salary related payments. So in this case, you would estimate still the amount to be used, but essentially that whole bank of hours there, it's going to be calculated as a liability. Just kind of determines what portion is going to be considered current um, and estimated to be used, maybe in that crossing that one fiscal year. But if you know that that employee is entitled to 100% of that sick bank or that vacation bank or comp time, which is very common in New York, which usually operates kind of like vacation. So if an employee works overtime and they can elect to, in lieu of getting paid the overtime in their check, they could either sometimes it's a one for one kind of hour banking, or depending on the hour level, it could be like a 1.5 or double hour banking. Same scenario would apply for that type of comp time. It'd be treated just like a vacation and be part of that compensated absence liability, especially if they're paid that out upon termination. Um, so situation three, which I think a lot of cities are going to be kind of a combination of two and three, potentially depending on what type of benefit is in play. So in this instance, not paying any hours upon termination. So when you're kind of thinking about those two buckets between either being used for time off or paid upon termination, it would still hit that bucket one. So this would be the impact, for the city that I was at, where you're going to now have that estimated leave usage that's going to be paid out. Could be, whether it's short term or over, a long term, greater than 12 months. In this case, you kind of look at the historical averages and calculate the leave based on that estimate using that pay rate at year end. Um, and again, kind of how to get to that estimation is going to be the big varying factor. But again, as long as it's reasonable and documented, that's that's the goal. Um, so here, the state controller put out an example of, they do pay out balances upon termination. but not at 100% of the bank. So in this case, still kind of operating under that two bucket approach. You still have that bucket one of, okay, here is based on the bank of hours. Here's what we're estimating that the leave usage will be, whether it's based on historical averages or sampling of employees. And then that calculation using the balance sheet pay rate would be essentially, those hours will be backed off. And then that would leave you that remaining hour bank of either sick or vacation or comp time to be evaluated at the termination date. So once you kind of back off that estimated leave usage amount, that remaining balance would kind of be the pool to be looked at based on the policy. So it could be maybe they get half of it, maybe they get, depending on years of service, maybe there's like a tiered system of percentage that they would get. In that case, if you're doing it by an employee at a specific level, you would calculate it specifically based on that percentage. Or if you're kind of looking at it from a average standpoint, at a department level, you could do it that way too. I think there's just a couple more examples, but here, if you're paying out balances upon termination, but maybe at a different pay rate. So still step one, the theme is always that first bucket, estimating the leave usage, based on the historical averages. And, in this case, I think it could be a set policy requirement where, like I said, maybe based on employee position or title at termination, maybe there's a set hourly rate that everything gets paid out at. Maybe it's kind of like a sort of a CalPERS or the New York State retirement system where it's averaging pay rates and it's kind of paying it out at that rate. But same process would apply where you're backing off that estimated usage hours and then taking that remaining bank balance and determining the rate of pay that'll get paid out at. So whatever reduced rate is in the policy would be applied to that remaining bank. And then last example, payout of balances at termination, but there's a cap on the hours to be paid out. So, could be, 100-hour cap, 200-hour cap. Step one is always the same. You have that bucket one, that estimated leave usage. And then those hours are essentially backed off that bank balance. And then that remaining bank balance that is going to be accounted for at termination with any sort of particular cap that's specific to your policy. You would back that cap off that ending balance. And same rules apply, assuming this is paid out at just whatever rate of pay they are upon termination, you would use that balance sheet date to estimate that. And I think the common theme is really bucket one is that leave usage, and then bucket two is that paid upon termination. So yeah, that is all the slides that we wanted to get through. I can I know there's quite a bit of questions in the chat that we will kind of scan through it and get to. But we also wanted to just let everyone know as well that we are kind of kicking this series back again. So we're going to have a number of webinars scheduled to take place over the next couple months. And the next scheduled one will be in a couple weeks on June 17th. Nilsina Shirk, who's a senior manager in our assurance and advisory department, um, will be presenting on that. So there will be an email um, to come, and there'll be some information on how to register. So please give us a day or so, but that email will be coming out. Um, so scrolling through some questions. Um, so regarding the GASB, the GFOA tools, in the FIFO LIFO results, I think you know the best recommendation that we would have in terms of how to determine which approach to take is kind of look at how you've been calculating the balances in the past, and um, it's unlikely that there'll be anything explicitly stated in your policy about the flow assumption. But I think if you break down how you've been calculating in the past, you can potentially gauge which approach you were doing, and that would be kind of our recommendation before formally putting it in the policy. And then in terms of the sick leave template, dollars paid versus the days used, I think in terms of what factors to go into is really just, if you're taking a sample of terminated employees, which is the dollars paid approach in the GFOA tool, um, I think you guys, know the specifics of those type of employees. If you think it's indicative of future usage, that's totally fine to use. Using the days use approach, if you're breaking it down, sampling employees in particular departments, looking at a couple year average of historical forfeiture rates, um, might be a better indicative of future. But I don't think the one thing we would say is just using whatever gives you the smallest liability is probably not not the route we would um, suggest. Um, so there's a question on the sample provided by GFOA. So our hours accrued include total bank or just for a year. So it would be total bank, and average the hours accrued for each labor groups. If you're breaking it down by department, um, assuming you have a very large agency that is not, you know, really conducive to breaking this down at a specific employee level. Um, you know, the GASB has been fine with looking at it on an average basis. Really, just kind of comes down to that reasonableness check and kind of looking and supporting and documenting the calculation to provide to the auditors. You can also kind of look at it and say, from a drastic perspective, assume nothing is used and then assume, every hour is used. Like, what is the actual potential swing from a materiality level of, depending on how the calculation that you're going to apply is. If it's a super drastic swing, it kind of lets you know, okay, it needs to be um, maybe more precise. It could be maybe that the overall impact could be immaterial from an actor perspective, and maybe in that scenario it could be dictated more of, okay, we're going to make some more general estimates based on departments. Um, so then we have employees who have been just hired. In that case, there's, not necessarily going to have a historical, use average. I think in that scenario, it's going to be, kind of just that'll organically be kind of built into that eventual 10-year look back period that I think the GASB ultimately wants us all to get to, kind of building off this kind of implementation kind of initial analysis. I think it'll get a lot more refined as the just the years of data is available. Um, I would, I think, you know, another area would be there could be policies regarding like software retention of particular leave usage, or maybe there are current policies in place now about a particular retention rate. Um, it would be worth looking at your policies to see if that is in any sort of IT policy, and if so, potentially there's a way to get more, maybe a different policy specifically to leave usage if you want to ultimately get to kind of a larger look back period. Um, is a recommendation that we have seen as well. Um, if you're, do we have to include only active employees? How about termination in previous years? If we're looking at the history of 3 to 5 years, I think overall, it would be kind of looking at like I would still say like a year by year basis. So, um, if you know that maybe there's a year with significant terminations that year, it could be maybe we leave that year off the analysis for that initial implementation year if you know it's kind of a one-off. I think that would kind of fall under that that one criteria. If there's any known information to the government that would indicate that potential historical data is not necessarily indicative of future results, I think I would say maybe leave those years out. There's no, you know, if you do that look back period and you determine that, there is a lot of, weird stuff going on in some of those, and even maybe in both previous fiscal years, um, maybe you just sit down with your auditors and kind of work together to find the most efficient way to go about this. But I would say if there are any sort of unique circumstances there, um, I would say to kind of err on the side of caution there. Um, when is it considered best practice to revisit the historical data used? Um, I think just kind of as each year kind of progresses, and we're kind of looking at um, a comparison as we get more data, and each year we kind of build upon that initial implementation pool. Um, I think, you know, if you start to determine that there are maybe one of those years was a significant outlier, um, maybe kind of back that year out, and just kind of take it on maybe a kind of a portion of those years in the look back period. I think really the ultimate goal is just to get kind of a reasonable analysis, and there's always going to be, not every year is going to be the same. So, if there's, significant fluctuations each year, you do kind of want to capture that in the liability too, because maybe every year, there's significant terminations or significant retirements. So, in that case, maybe it is indicative of, future results, and would be part of just that overall analysis. But I think, you know, the GASB overall, just through some discussions that we've heard, kind of is ideally looking at like a 10-year kind of period. But, upon implementation year, we're not going to really have 10 years worth of data. So we're kind of starting with a smaller window. And I would imagine as we kind of get into like year 4 or 5, um, you know, there'll be more of a basis of trends, and the calculation potentially, is more accurate even at that point and more kind of honed in on the specifics of your agency. Um, Rather than doing it on an employee basis, For historical usage, can we use averages? Um, yep, I think averages is totally fine. Um, it could be depending on some of the software reports that you could run. Maybe it's easy to run it by particular GL account strings or departments or cost centers or whatever kind of it's being tracked internally. Looking at averages overall as a group um, is totally allowable and you know totally reasonable. Um, is LIFO or FIFO being used to calculate short term versus long term? So overall, LIFO FIFO is going to be more just of a general um, kind of um, starting point. So you'll still kind of have that, current portion, but the with FIFO, it'll be just a bigger pool of the liability to kind of work from. From a LIFO perspective, it could be that there you could make an argument or documentation that maybe there is no current portion for this particular, sample or average of employees because, or if you're doing it at an employee by employee level, you could say, historically, this employee in the last 2 years has never used more than they've earned, and we're doing the LIFO cost flow, then essentially it's looking at, that bucket number one of estimated usage is kind of not in play. And then you're kind of moving to that bucket two where you're saying, okay, maybe it's not current, but there still is a portion, maybe based on your policy of a reduced amount of that remaining pool that could be paid out. Um, so I think the current long-term portion will still be, subject to analysis, not necessarily, um, dictated per se by LIFO FIFO, but it's going to kind of depend on each employee usage. Because if an employee is historically using more than they're earning, then there could still be a current portion regardless of the flow assumption. In terms of policy updates, we can, during the interim process or, over email, we can, um, probably put some sample verbiages together. Obviously we can't help necessarily write the policies, but if you also want to kind of just put some verbiage together, we're happy to just kind of, make sure there's nothing, you know, inconsistent with GASB 101 in general, and kind of help kind of gauge how reasonable those policies are. I know we're kind of over the time here, and I know there's still quite a bit of questions. So, from this point, I think um, if anything, if there's anything that really hasn't been, um, so here's just one that popped up, government-wide liability or general government fund level. For the most part, that'll be unchanged, unless there is some sort of current portion that is estimated at the fund level. But for the most part, there'll be no change there. Obviously, like your DPW or water sewer funds would, have all that activity recorded. But there shouldn't be any change in terms of the presentation. Um, so again, I know some of the answers kind of address multiple questions in there. Cami, I don't know how long we can go necessarily, but
No, yeah, thank you, James, so much. If we didn't get to your questions during this Q&A session, you can always reach out to James after this presentation. These are all great questions. We can even try to put some content together to answer all of these for all of you guys. So just keep a lookout for that follow-up email that will have today's recording, the slides from today, and also the registration link for the next Back to Basics webinar on capital assets. So thank you everyone for coming, and thanks again, James.
Thank you guys.